thank you everyone for being with us today. We're very honored to co-host Global CIO Symposium themed global investment paradigm shift with the Financial Times and ftchinese.com. Today, we have two veteran investors in fixed income from a long-only manager and a hedge fund manager that are very well known. Mr. Richard Lawrence from Brandywine Global Investment Management. Brandywine is very well known for its interest rate research, global macro research, and duration management with a AUM of $67 billion US. And Mr. Boaz Weinstein, founder and CIO of Saba Capital Management with firm AUM of 3.5 billion. And Mr. Weinstein is known for his creativity in credit derivative investing when he was a global head of credit trading at Deutsche Bank, where he had the proprietary trading desk with a large workforce and invented Saba principal strategies. And he's an expert of capital trading between capital structures in different countries and credit derivatives and equity derivatives and long volatility to building a lot of creative ideas into one portfolio. So welcome Boaz and Richard to our symposium.
Thank you, Vanessa. It's an honor to get to present to this group.
So let's begin with a philosophical question that as a fixed income veteran investor, there is a philosophical belief interest rate and the credit spread are the regulators of economic cycles that drives the business cycles with a mean reversion tendency. However, over the last 18 months, the very unconventional monetary and fiscal policies worldwide in reaction to a once-in-a-century pandemic, how does that impact or distort, for lack of better words, the fixed income price discovery and valuation, and how does that offer any opportunity or risks in your investments? So let's start with Richard.
Vanessa, thanks, and hi everyone. It's really great to be part of this event. So Vanessa, that's a very good question, and I would say that our view on this is that while unconventional policy has possibly suppressed the absolute level of rates, it hasn't entirely inhibited our ability to obtain price discovery signals. I mean, if you think about what happened in 2020, there was an incredible reaction in terms of spread markets at the peak of the crisis. And that's something that we were very much able to take advantage of and exploit. So while the overall level of rates may be somewhat suppressed, and I wouldn't even necessarily characterize this as purely a COVID era phenomenon. You can argue that we've been in an era of unconventional central bank policy really since the great financial crisis. We've been doing QE to some extent in the US for the last 12 years. So the idea of unconventional policy distorting price signals is something that we've talked about a lot on the team, but yet we've been continuing to create significant outperformance against the US aggregate benchmark over this entire period.
Right, we'll get into more of how do you do that, but now Boaz, and how does this environment, particularly over the last 18 months in reaction to pandemic, creates opportunity for you? We know that you have a very creative strategy.
Sure. Well, certainly, even just to start with Richard's comments, which I generally agree with, I think that all the efforts of the central banks only can go so far. And so, for example, last year during the pandemic, the most traded index of U.S. high yield credit, which has 100 companies in it, 9 of them defaulted. So no matter what the Fed and the executive branch were doing to protect the economy, we still had a 9% out of 9% nominal default rate, and with very low recoveries. Some companies like JCPenney and others that defaulted almost recovered nothing for the bondholders. But at the same time, the most amazing thing we saw from the Fed during the pandemic was, for the first time, buying ETFs that hold broad US junk bonds. And this was really a shock to the market. And I believe it happened because today in the bond market, it is so different than 10, 20 years ago, where there's such a high proportion of retail investors that own daily liquidity products like mutual funds and ETFs and other sorts of products that give them exposure to high yield, which can be risky. And all of them were seeing significant outflows during pandemic, and those outflows were feeding upon themselves. So the bond market basically broke down and the Fed stepped in, and that's pushed us to a level this year where there's, first of all, I want to say about 2021, there's very little discrimination between one credit and another. Basically, the worst credits, the triple C, have done the best, and the highest credits, the single A, which are more connected to US Treasuries, have done the worst, and it's created a very narrow difference between different quality credit, and that is interesting and full of opportunity. What we've been focused on this year, though, is that we are seeing altogether very low yields at a time when we have rising inflation, and whoever, from the Fed chair down to top economists, whoever a year ago was saying there will be transitory inflation, they've already been wrong in effect, because the delivery date for when the transition happens back to low inflation, has been pushed out, and maybe pushed out significantly. And so here we are with high yields where we started this year yielding only 3%, and there's still some loan funds that yield just 3 or 3.25, 3.5, but we have inflation running above that, and that's before you even consider defaults and all the other risks that a high yield investor takes. So to summarize, we actually are very worried about the level of protection, the level of yield, even not for inflation. And so we've been focusing in other areas, and I'm sure we'll get to talk about it. But one of the hidden gems of the US market is to look at SPACs, which I can explain and go through in as much detail as you want, but there's been a lot written about SPACs. There's 140 billion outstanding in the US and over 500 that are looking to make an acquisition. But those SPACs that are generally thought of as equity products are low enough that they offer yields. And even though their risk in the first stage is US Treasury bills, so short-term US Treasuries, even though the risk is similar, very much similar to US Treasuries, the yield that one can get is similar to high yield. And that is very interesting to us.
Right, Boaz, you alluded to my next question. Actually, there has been a long debate on, what's the point of owning a fixed income instrument in a portfolio, on the breakdown of the traditional 60-40 construction of a portfolio. And as you said, the rates has been kept low, and the risk assets has been soaring, even higher. So fixed income actually becomes very expensive in general, that the return outlook on asymmetrically, perhaps on the risk side rather than on the upside, to offer a return free risk rather than risk free return. So you mentioned some of that in your comments. And turning to Richard, do you agree with these doubts of the value of still owning fixed income and in a portfolio? And other than SPACs, we will circle back to that. As a long-only conventional investor, where do you find attractive alpha in this environment that fixed income has generally become very expensive through your strategy?
Yeah, so when I think about the role of fixed income in a client portfolio, I mean, it's a little bit how I think about buying insurance, right? You have to buy health insurance, you have to buy life insurance, you have to buy property insurance, and sometimes you look at all of that money you're spending on premium and you ask yourself, is this worth it? What am I getting for these premium payments I'm making? The reality is that there's always going to be a role for fixed income in a client's diversified portfolio. Even in an environment where it looks like, Tina, there is no alternative other than to own equities. The reality is that, a significant equity drawdown is only, one policy error away. So, I'll remind you that, the S&P 500 has had 10 drawdowns of 10% or more during and since the great financial crisis. And our portfolio has had positive returns in 9 of those 10 drawdowns and outperformed the US aggregate in 8 of those 10 drawdowns. So I regard what we do as somewhat unique because we provide that type of portfolio insurance, yet at the same time we're significantly outperforming the ag for you over the cycle. And what's the secret sauce and how do we do that? Well, it's because we're extremely opportunistic in terms of how we manage the risk appetite of the portfolio, in contrast to what I would say are traditional fixed income managers who sort of have a permanent bias towards spread because that's where they think they're going to get their return from. Our approach here, our secret sauce is to rotate the portfolio quite aggressively between duration and spread. So, obviously that's something that I think is highly differentiated. So while fixed income in aggregate may look like an expensive asset class, we still believe that A, it serves a role in the portfolio, and B, you need to have an unconventional approach in order to have that insurance actually provide you some type of return to the portfolio.
Thank you. So the secret sauce for Brandywine is to rotate between segments and duration. And circling back to Boaz, you mentioned the SPAC. On the equity side, the SPAC as a new asset class perhaps had the best year in 2020 and rolled over on the equity offering side in 2021. And for equity investors, perhaps they need to be very selective in picking the good ones versus the not so good ones in order not to step into a sub story. But as a fixed income investor, how do you pick the opportunities as a hidden alpha from the spate of SPACs that's different from an equity investor's perspective?
Yes. So we have been really focused on SPACs also because we disagree with Richard, because we're concerned that the last 10 years, the last 20 years is a false signal. We've been in a period of declining interest rates. And if it so happens that you just start with, what if interest rates go up a lot? Okay. If interest rates go up a lot, that fixed income safety, that insurance will turn out to be the opposite of insurance and lead to extra loss rather than not leading to insurance. It actually can exacerbate the loss. So we are quite worried that the market, no one, including myself, has traded through the early 1970s where we did see significant inflation. And this is not our prediction, but if interest rates went down for 13 years and now they're starting to go up, it's logical to say perhaps we're not getting enough protection, like you put it, Vanessa, with return-free risk. So why do we move over to SPACs, to come to your question? Because SPACs hold US T-bills, so really under 6-month duration, but you can get a yield often over 3%. and the average yield is lower, it's in the twos, but 3% is 3 times what you could get in a 4 or 5 year US Treasury, and you only have 6-month risk. The reason we like it extra, though, is because it is misunderstood. When the SPACs were trading, like you said, very well in 2020, they were trading at big premiums and there was no yield. But the yield that comes in SPACs today is because you can buy the stock for less than what you will get back in the future. And so it's like owning a zero coupon bond. You can buy something, sell a warrant, and own it, let's say, at 960 with 1 year to go. And so 1 year later, 960 will become 10, and you'll make 40 cents over 960. You'll make a little more than 4%. But the hidden gem is also that you retain an option that if the manager finds someone attractive to buy, that the market will reward you with equity-like upside. There are a number of deals just this week of, for example, Swedish car maker, electric vehicle maker Polestar, that the market has had a very favorable reaction to that deal. Of course, the Donald Trump media deal sent the SPAC up 600% to current levels, but that's an exception. But there are many examples just these past 2 weeks of up 10%, up 20%. And this is free optionality for an investor that in fixed income normally doesn't get such things. And so our edge is looking creatively at how to transform thinking about one asset class to another. We do this between credit and equity, and in SPAC below par, it's clear, offers a yield. And on the risk side, Vanessa, we for most of our investors will never keep the SPAC after it turns into a private public company, and once the Treasury protection is gone. When the Treasury principal protection of T-bills is there, we're interested in owning this option. When that's going away, we move on to a different SPAC. So for us, it's very defensive strategy with nice yield.
Well, thank you for revealing that playbook of as a fixed income investor, how to take advantage of this new asset class and move from one opportunity to another to take very limited duration risk. And going back to Richard, Boaz, you perfectly alluded to my next question. Fixed income could, and this year had experienced some stiff volatility, and investors own fixed income in the portfolio. As Richard mentioned, part of the value is for insurance policy. So how does a long-only strategy balance the defensiveness and the search for yield that the investors look for, both in a fixed income portfolio in this environment?
Yeah, and obviously, just to be clear, what we're doing in this particular strategy is not only is it long only, but it's investment grade long only. So the universe here is pretty constrained, and so it's really hard in this environment to think about this as a yield-seeking opportunity, which is why we really view the opportunity to add value and that alpha comes from.
How about we expand outside of the particular strategy, but just in general?
Yeah, well, once you expand outside that strategy, that gets a little bit more interesting. To Boaz's point earlier, we still, we would see there's still some select opportunities in the high yield market. Default rates still look relatively benign there. But the idea behind what we do, at the core of what we do, it's really just a combination of using the value signals that come from the markets and from our proprietary models, and marrying that up with pretty rigorous macro analysis. So our whole approach is very much a top-down macro-driven approach. It's all about analysis of the business cycle, monetary and fiscal policy, ESG factors, what credit growth looks like, what the lending standards look like. So, the approach is really sort of a combination of what are the valuation signals telling us, where are markets deviating from intrinsic value, and what we think are the macro catalysts that could unlock mean reversion opportunities. So last year would be a really good example of this, right? So in the middle of the crisis, we see, triple B spreads blow out, 350. And so, there's your valuation signal. Right now, you're looking for the macro catalyst that will lead to the mean reversion opportunity. And it comes through the Fed making, guarantees in the primary and secondary investment grade credit markets. We felt that would lead to, spread narrowing across the curve, even though they were only guaranteeing paper out to the 3-year part of the curve. And so, the strategy that we're talking about here, the US fixed income strategy, aggressively rotated into, long duration credit, and has, really been able to earn some significant return as a result of that. I mean, the strategy last year was up about 17% as a result of that rotation into long duration credit, and we've been just doing profit taking on the position ever since. So that's really how the strategy works. It's using our value signals and our macro signals to identify where we think the next significant opportunity is going to come from in our market.
So, Boaz, you mentioned that you're very worried about what if interest rate goes up sharply, that challenge the people's past dependence over the last decade after the global financial crisis, that the world has gotten too much used to a low interest rate and may not wake up swiftly enough to a change of the paradigm shift. And so how do you, in your strategy, offer that combination of defensiveness with return?
Yes. And, we don't have a crystal ball about inflation, and we don't even have a strong view about it. Even if our crystal ball is broken, we don't even have one. It's in the closet. What we have is an understanding that even if the event is a somewhat lower probability event, the reward is just not there for taking that risk. We did not have to talk for the last 10 years about inflation, being even at 3 or 4% trailing last 6 months, but here we are at 5, and it's not really abating. So we are thinking more just purely about the reward and the risk, and this is what gives us pause. So what do we do for defensiveness? Because Richard's certainly right that in the past decade, 60-40 plans and fixed income investors have really benefited in stressful times when one of those 10 equity corrections happened. What we do is, and in fact, the biggest strategy in our firm is actually providing direct insurance against a sell-off, not by owning US Treasuries, but by being short credit spreads through my domain expertise, which is the credit derivatives market. The credit derivatives market, for those a little bit less familiar, last year, just the indices, just the US and Europe and Asia indices, which have hundreds of names in them, traded $19.5 trillion of notional. And the biggest asset managers in the US, from BlackRock to Blackstone, Bridgewater, are all major players in the space. And then there is, of course, a very big market for single company credit derivatives. And so that's something I did I was very lucky to join in the credit markets at a time just before it became a new thing. And so I've been doing that for more than 23 years. And credit derivatives today, because getting back to what I said at the start, that triple Cs have done well relative to single A and double A credit because of the move in interest rates affecting investment grade more, we see very little differentiation, very little dispersion. If you look at the returns this year, there are very few credits that went up a lot or down a lot. Everything really moved in a pack. And so that pack right now, because of the Fed's extraordinary actions and, let's say, maybe misplaced confidence, means that you can go short some companies that are regularly problems during sell-offs at the same level that you can go long companies that are regularly very safe. And so in the US, most of the banks that make loans to venerable companies like Procter & Gamble and IBM and AT&T and Disney, those banks have desks whose job it is to hedge that exposure, and they will pay a price. They're not trying to make profit in this hedging group. It's more like utility. They will pay a price that lets us take risks to these amazing companies, and at the same time spend that money on protection that has been very valuable. And that led us last year to having such a good result through this insurance product in our main fund that we won the Risk Magazine Hedge Fund of the Year, really purely because of this strategy. And I'm very surprised but happy that 1 year after COVID, the opportunity to put on this insurance is as good or better than it was before COVID. So we don't know when the next sell-off will happen, but we are ready for it.
Wow, it's fascinating to hear both, in a hedge fund space, a manager to talk to in a long-only space with, different approach to come about to offer the same nature in a institutional portfolio. So let's get outside of the U.S. market for a little second, as both of your firm are investing globally across countries and fixed income segments and capital structures and the currencies to find that relative value or opportunity. And can you elaborate on, where you see the most attractive relative opportunity across countries, segment, and capital structures in next year as we're sailing into 2022, and particularly in the long context of a whole year debate on transitory / persistent inflation or stagflation worldwide, and where do you see opportunities outside of US and across capital structures? And let me circle back to Richard.
Vanessa, thanks. So yeah, as a team, we manage about 50 billion in global fixed income assets, and so we're looking at roughly 30 to 40 markets around the world, and their currencies and their spread markets. And I would say actually next year could be a pretty interesting place to start overweighting emerging markets, particularly local currency emerging markets. The reason I say that is because right now we're in the middle of a central bank hiking cycle in emerging markets. These inflation pressures, particularly food prices in some of these emerging markets, have forced the hand of EM central banks who simply don't have as broad a tool set as the developed market central bank, or certainly not as deep a tool set. So in response to rising inflation pressure, what we're seeing right now is EM central banks around the world hiking rates pretty aggressively in some cases. Brazil, Mexico would be a couple that come to mind. As that hiking cycle starts to take a bite in terms of the inflation pressure in EM, that I would imagine would set up for a pretty nice opportunity to extend duration into some of these emerging market local currency markets. Obviously, this has been a challenging environment in which to be long EM, which frankly we have been in some strategies. Some of the commodity emerging market currencies simply have not kept up with commodity prices, which has been a little confounding for us. But 22 looks like an environment where that might set up to be a pretty attractive opportunity. The other interesting area would be in FX in general. And you think about fixed income markets broadly, something Boaz and I think would both agree on is that, valuations are pretty tight almost everywhere. And I say almost everywhere because FX actually happens to be one of those places where you actually still have some legitimate cheapness. If you think about some of the currency markets that we track on, say, a purchasing power parity basis, you've got currencies like the Malaysian ringgit and the Colombian peso, and even high quality currencies like the Norwegian krona, all 20% or more cheap on a PPP basis. So we think there'll be an opportunity going into 22 to perhaps extend into some of those currencies. The wild card there, of course, will be, how the Fed reacts to, current inflation pressures. We'll obviously learn a lot more in the November meeting, which takes place today, ironically. We'll get a little bit more visibility into what the path of the hiking cycle looks like. We're still in the camp where that's probably in the back end of 2022 at this point, but obviously we'll learn a lot more a little bit later on that.
So Boaz, where do you look elsewhere other than US?
Yes, well, if you look to Europe for credit, you find even lower yields than you have, and we even have some negative yields. And so Europe is not the place. And in Japan, we have exceptionally low yields, even though some of the companies are quite cyclical in nature and have had a lot of name volatility, like Toshiba, which had a crisis because of Westinghouse, or Kobe Steel, which had a crisis because of some unsavory things at the company. So in Japan, the spreads are so low that there's often news, and the risk is also not appealing. So where does that leave us? We don't have emerging markets and macro type of expertise to want to speculate on currencies the way Richard and his team can and do, and really our expertise is more about trying to find cheap options. And so when it comes to FX, it is not lost on us that that owning volatility on various currency pairs can be quite appealing in risk-off moments. And today, the level of volatility has dropped to being at quite low levels, where in 90% of the history, the realized volatility has been higher than the implied volatility is today. And so we're looking at at how to buy more options for our investors, because we think the next 10 years, as much as Richard's absolutely right, there have been all these corrections. We had the biggest decline last year since the Great Depression, and then in equities, and then the biggest rally of all time. We still, looking forward the next 10 years, considering that the S&P, in March 08 was at 660, and here we are, at 4,600, up 7.5x, plus dividends, that the next 10 years are very, very unlikely to produce the same kind of returns, and the market will be, if anything, more difficult than it's been since 2012. And so we want to own volatility. We think there are many ways to do that attractively. And what that also allows us is that in those moments, like when Richard mentioned triple B spreads at 350, and you had a catalyst from the Fed, in those moments, I think investors are often not in a position to add. And I'm very glad Brandywine was able to add, because there are a few moments in a year or in 5 years where most of the return will come from those few months. And to be in a position where you can buy is one of the most important reasons to have insurance when you don't really want to buy, and is to prepare. And so we are prepared.
Yeah, I could not agree more with what Boaz just said, which is that the grinded out, picking nickels up in front of a steamroller approach to fixed income is dead. You kind of have to go. You have to go big, active, bold, and that's that's very much characteristic of sounds like Boaz's style, and certainly our style too.
So go big, active, and bold. That's the takeaway out of this panel discussion, perhaps. I do wanted to circle back to Boaz's comments on volatility. So is it correct to understand that in your strategy, you're also building long volatility and the long convexity element to your overall strategy to offer that downside protection?
That's actually the foundation for most of our funds. Not all of our funds. We have some funds that just buy SPACs and don't do anything else, or just buy closed-end funds, which are funds on the New York Stock Exchange or London Stock Exchange, where you can buy $1 of NAV for maybe 85 cents or 83 cents in some cases. Those businesses are meant to provide long-only investors with some excess return. But most of our capital is very much centered on what you said, Vanessa, which is trying to find cheap volatility. And often when it's no longer cheap and the sell-off has happened and you don't want to own that volatility anymore, there's actually all sorts of new things that pop out of the marketplace. I think one important distinction that people do not think about enough with fixed income compared to equities is that if we just imagine we buy 10 stocks, what will happen over the next 5 years? We check back 5 years later. Some of those stocks, maybe we were lucky and we had Tesla and it's up 50x, and maybe we were unlucky and one of the companies is down 1x, is down to 0. But we will have a huge range of outcomes. If we did that with 10 high yield bonds, okay, even the ones that are Tesla, let's imagine we actually owned a Tesla bond. It will never, ever give you anything more than your money back. It won't even give you a spare part from the car as a token. You just get back par. And so the outcomes are so similar. Other than default, every fixed income asset will mature at par, that you actually don't have very much differentiation. And it actually, whether it's nickels in front of a steamroller or didn't matter whether you went fishing or you were at your office, it kind of, in the end, didn't matter. And we don't think that people are so skilled to be able to buy and sell and pay transaction costs and dance in between the raindrops, as we say here, that this is necessarily a good activity. So what is the value of fixed income? It's all about those moments when a big event has occurred. Were you prepared for it? And when it happened, did you capitalize on it? Because that's where the great returns are. Whereas in equities, in a normal year, there's a lot of things to get right and wrong, but that is not really true in corporate credit, at least. And so this philosophical perspective, I think, helps us not worry about, are we keeping up with a long biased fund in a quiet year, because those nickels, will end up costing them many years of returns, or we can make up for owning volatility in low vol years with one big surge of volatility. So that this is our philosophy.
Well, that's a very crucial reminder, actually, to asset owners and investors who might have gotten too used to the last decade of a low vol environment and become numb in a way to the possibility of a risk that volatility could spike, and in a new paradigm that we are sailing into, and we can talk for another day of why the volatility regime might change as a part of the paradigm shift. So thank you very much for pointing that out as a reminder that often forgotten in looking at the next decade of investment in any asset class, perhaps beyond the fixed income. So, Richard, to your earlier comment about emerging markets, actually, I can't help to mention China in fixed income investment of a local currency. Last year and this year, Chinese local currency credit has done quite well because of the macro recovery. Economic cycle is different from U.S. Given the cascading nature of different economies getting out of the pandemic, as well as the different macro fiscal policy cycles. So there is a attractive return to be made domestically in China credit market, where the Bond Connect was open last year, and on both directions open this year. And actually, the local credit, there are some default event both in the local market and in the offshore markets that actually offer price discovery opportunities for very active investors that are smart about and informed about the risk taking in China credit market, which is much less accessible to global investors traditionally because of the regulation. That lead to my next question. Actually, Chinese property market has drawn a lot of attention recently because of certain property developers have defaulted the offshore credit, and international investors do worry about whether the default would be contagious and whether the government has the ways to contain it, and how much of that impact is local and how much of that impact can spill over into something bigger. So Boaz, we know that you have your building a sub-strategy in your portfolio to find opportunities at different capital structures using and between credit and equity on the same company. So some of the Chinese property developers might be one of those opportunities that you smartly investing. So can you tell us more about how do you go about that risk taking while others might be running away from it?
Sure. So I'll try to explain it in a clear way, because this is one of the more complicated parts, strategies that we employ. But every night we run a screen where we compare the yield of 18,000 different bonds globally and the cost of buying a put on the stock. Now, why do we do that on the same company? Why do we compare the yield of the company to the debt to buying a put on the stock? Because I spoke earlier about transformation, that often some of the best inventions or most creative ideas are not because you came up with something particularly new, but that you saw something in one sphere that reminded you of something else. And when we think about bonds, I think many investors just think about them classically in the fixed income way. Here are the cash flows. What are the chances that they'll be able to service the debt or get downgraded? Is the leverage trending up or trending down? But a bond is really of a company, let's say a high yield company. We'll talk about China Evergrande, 3333 is the equity ticker, of course. That it's like a riskless investment in the currency, whether it's the U.S. Treasury or China sovereign debt. But on top of it, so you have your yield from the fixed income component, and then there's the credit piece. And the credit piece is not that different than selling, when you buy the bond, then selling a put on the company defaulting. Because in the end, if the company is doing amazing or not so amazing or terribly, but not default, you get back your money, you get back par. Just like in my prior example of 10 companies, if they don't default, you all have the same result, you get back par. It's much more of a boundary type of condition where you know the outcomes. It's either par or not par at maturity. And so the company is either in default or not in default. And so if you look at what happens when companies default, their stocks go to zero most of the time, and the bonds go to what we call recovery value. And so when we compare 18,000 bonds, the yield that we get compared to the price of the puts, actually China Evergrande, much before the trouble this year, stood out as by far the most interesting name, because they had debt issued in dollars, offshore debt with a coupon of 12% that were trading at a discount. So you, even in good times for China Evergrande, had 14% type yield. That's very, very high. I mean, everyone can agree 14% yield is high. It's especially high for a company that has a market value of equity value of $30 billion, as China Evergrande once did. And the cost of the puts was actually pretty low. When we look at companies that have that level of volatility, we find that their yields are not 13 or 14%, but more like 2 or 3 or 4%. And so high spread, low volatility is a very interesting signal, because it's the two markets saying opposite things about the risk. And we also liked with China Evergrande that the company, the bonds were protected to some extent through the ownership of public stakes in the in Hengten 136 or the China Evergrande Electric Vehicle Company 708 or 2066, a bank, or even the property entity 6666. So you have all these entities that are backing these bonds, and they're not all necessarily connected to the value of the main business. And so we just in our screen saw this thing that was super unusual, very high yield, very high market cap, very low volatility. And I think that those screens are not looked at by enough people and can lead, because too many investors are either fixed income or equities, or they're not also looking at things like derivatives. And so some of our, I'd say, best ideas come from finding inconsistencies that require then research, sometimes explainable and sometimes not explainable, and they lead to a trade.
I'm sure that you would be one of the very few to say Evergrande is the most interesting idea, while most of the people perhaps would say Evergrande is the idea to get away from. And so, Richard, to perhaps tie up this fantastic panel discussion, what are the biggest inconsistencies and unconventional ideas that you would embrace that others might not see?
Well, just on the topic of Chinese property developers, we have been kind of sprinkling a few of the higher quality names in there. I mean, we took perhaps arguably a more sort of conventional approach than Boaz has, and sort of asked ourselves the obvious question, which is, is the baby getting thrown out with the bathwater here? And we saw yields back up quite sharply in names that I would characterize as sort of higher quality, pretty low default risk, when the news got caught up in the sector more broadly. So that's certainly an opportunity that we've been taking advantage of. You talked earlier about the sort of the past difficulties just accessing the Chinese bond market for foreign investors. Something else that we have done this year is bought 30-year Chinese government bonds across the global portfolios. We see growth looking a little bit more challenged in the Chinese economy right now, and CGBs offer a really attractive yield premium to the treasury market. And you sort of do a 10-year look back on CGB returns, and they really do offer a pretty nice diversifying return profile to treasuries or bonds against most emerging and developed markets. So that's been something else that's been a little bit newer to our strategy. But really, in terms of sort of what's the next big idea, I suspect it's probably going to come out of some type of market reaction to moves that will or will not come out of the developed market central banks. If over the last few weeks we've seen just astonishing moves in the front ends of yield curves in places like Australia, New Zealand, and it does look like the market's testing the resolve of central bankers around the world, and we suspect that's probably going to create some near-term buying opportunities.
Wonderful. So, we have implemented Chinese domestic bond portfolio for our asset owners, and that is a part of the area in our portfolio that can offer specific diversification value as well as attractive yield. So, circling back as we close up this conversation to the theme of this symposium, the paradigm shift, can I ask both of you to give one closing note of what you think is the biggest paradigm shift in fixed income investment? And Boaz, please.
Yes, and also just to add, the Chinese market, there has been, I think, a baby bathwater situation that Richard mentioned, and it is full of opportunity and is one of the most interesting places to look at going long. In terms of a paradigm shift, what I've been talking to my investors about is that when I started in fixed income in the 1990s in credit, it was really a question of fundamentals. You analyzed the whole market, you put it into a matrix and said, this is here for this reason. This is the leverage. This is a triple B that might go to double B, so it's dangerous. This is a double B that could go to triple B, and then it has to be bought. And here it's you needed to know the fundamental story very well. I believe that 2021 will be remembered as a year when technicals, which had started to become much more important in 19 and 20, started to dominate. And we see in the US these examples like we had with Melvin Capital and these stocks like GameStop and AMC, these meme stocks, where it doesn't matter what the price is. It's not about fundamental. It's all about where is it and where will it go. And we saw this also in the Archegos situation with stocks like Discovery and Viacom. And so seeing how technicals can play a much bigger role than fundamentals in stock prices, it's also, I think, a little bit connected to how there's a new way of thinking about asset prices when you look over at crypto and NFTs, and the prices can be mind-blowing. Like, how can this be worth this amount? And then it goes up another 300-400%. So we've become untethered to traditional fundamental valuation and much more about who is doing what to whom and how much more will they do and what buyers versus sellers and what kind of things can occur, even ones that were beyond our imagination. So I think that there is also has its own role in credit markets and fixed income, even if much smaller. And so we are much more focused these days on technicals. Last year, it was the technicals of retail investors selling out of ETFs and mutual funds. This year, it's the retail investors buying meme stocks and prices being people much less confident in prices will return to fundamental value, and instead much more confident that the trend is your friend and the technical is the dominant element in investing today. I don't want to be too dramatic, but this is what I feel.
So Richard, what's your paradigm shift that's on top of your mind?
Yeah, so, well, it's interesting. I think I agree with what Boaz just said, but at the same time, that technical backdrop has unfolded in basically a unidirectional market. Once some of these first-time investors get taken out to the woodshed by a 20% correction, we might see some of that price volatility in some of these unconventional market sectors, if we can call them that, start to abate. I think the paradigm shift here is well, we're sort of in the middle of it, which is we're really asking ourselves the question whether some of this central bank policy is temporary or permanent. We at Brandywine, we kick around the idea all the time that surreptitiously we've moved into an era of modern monetary theory without actually realizing that we've moved into an era of modern monetary theory. So to what extent are some of the unconventional policy measures that have been put in place, are they never going to go away? And in fact, are rates going to stay relatively low indefinitely? Boaz referred earlier to the 70s being an era of persistently high inflation, which it was, but it was also an era sort of characterized by a very different demographic profile and productivity profile, and because of those reasons, we're a little bit more sanguine about the idea that rates actually may stay lower for longer here. Sprinkle in globalization and robotics and technology and nominal debt loads. And I think there are a lot of reasons why rates actually may stay range bound and volatile indefinitely. And that just might be the paradigm shift that we're moving towards.
So fixed income global investments be big, bold, and active, respect the technicals, and be mindful of volatilities. And that's the summary of this wonderful, wonderful discussion. Thank you both so much for being with us.